Hi everyone, this video is focusing on theme 1.5, understanding external influences, and today's focus is going to be on interest rates. So we are going to understand how changes in interest rates affect small business. You need to all be able to describe what an interest rate is and also define the differences between fixed and variable. For grade 4 and above, you need to think about the effects on interest rates going up and going down, and for grade 5 and above, you need to analyse how that affects businesses. For grade 6, 7 and 8, it all needs to be in context, detailed and justified recommendations of the way you think that business should move forward, and we'll go through some examples shortly. So, interest rates. It is the price you pay for borrowing money. If you borrow money, it is not going to be for free. If you go to the bank and borrow £200, it's going to cost you more. It's almost like the fee that is expected for the admin and the time and the length that you've got that money for. So if you borrow money from the bank, how they make their money is charging us interest on that. So the definition according to the GCSE textbook is the rate shows the amount of money that has to be paid to borrow that sum of money. This is expressed in a percentage. So just a couple of examples to put it into context. So cost to borrowers, if you had £1,000 loan and that loan had 15% interest attached to it, it would be £150 a year. That is on top of the 1,000. So you would be expected to pay back £1,150. Interest rates don't just affect loans as well, they affect overdraft facilities. So if you go into your overdraft, and an overdraft is almost a deficit in your bank, going minus, borrowing almost, a short-term source of finance used by businesses a lot to oversee and overcome short-term cash flow problems. And you also have interest rates on loans to buy new machinery and expansion, and that always tends to be fixed and budgeted. You know how much interest you've got, you're paying it off, chipping away bit by bit for so many years, same monthly repayment every time. In high interest rates affect savers too. The higher the interest rate, the more you get back for your savings. So if I had £1,000 sat in my bank as a plus, and the interest rate was 15%, then at the end of that year, I might have 1,150% in my savings account. Who sets the interest rates? Well, it's the Bank of England. It's the Bankers' Bank, the bank of all banks. And what they do, the MCP, which is a Monetary Policy Committee, they get together, they have a chat, and they decide upon what is the ideal base rate. I mean, in the past, we've had base rates of 1%, 0.75, 0.5, and currently we're on a 0.25 minimum base rate. Now, the base rate isn't what interest me and you pay. That's totally different because the bank add on their percentage on top. But obviously, if the Bank of England are discussing with the monetary policy and that committee, and they decide that the base rate will be 5%, say, then the bank will add their little percentage on top, and that means that interest rate could be 7, 8 or 9%. So this rate affects banks, which then affects us as the public, and it's all reflected upon them decisions that are made in the Bank of England. Fixed and variable rates. So variable rates of interest change every single month, and they change after the Bank of England release the base rate. So for example, if my mortgage, which is the interest I pay on the amount I've borrowed to buy my house, if I've got a variable rate mortgage, what might happen is I have £500 a month to pay. The base rate goes down. I might pay £460 a month. The base rate goes up. I might pay £550 a month. And what I'm doing is I'm almost gambling on what the base rate will be because my mortgage would be variable, it varies upon the interest rates that are set by the Bank of England. So what that might mean is a very, very unstable payments that I pay. But if the base rate goes down, which it has gone down again to 0.25 as of March 2020, that's low as it could possibly be. So my mortgage payments will be very, very low. However, if they change, then payments could get very, very high. And if I couldn't afford to pay them, I could lose out on my house. They could take my house away, repossess it, because I can't keep up with them repayments. Now, a fixed interest rate would be one that is stable, so it's set. So, for example, my actual mortgage is a fixed rate mortgage, and I think it's fixed on 3%. So it's 3% every single month, so I can manage my payments. Right, that's £500 a month every single month for the foreseeable, and that way it's easier for a business to budget, although not necessarily the best value for money, but it would all depend on the economy. So fixed rates do not change until the loan has been repaid. Less risky, but could cost you more. And a variable rate would depend on the base rate, could go up and down, is seen as quite risky. So in the exam, what we'll need to do is consider these type of questions. How do interest rates affect consumers if interest rates went up and down? Why might a consumer want to have a loan? How would the interest rate affect them? What kind of products do customers tend to borrow for? Will these types of firms see a drop in sales if interest rates rise? And are consumers more likely to borrow money if the interest rates are low? So let's consider those following questions. You might want to pause the video and have a little think. So, quick knowledge check. What do interest rates affect? The answer is everything and everyone. It affects borrowers, it affects spenders, it affects the prices of goods. Who sets the interest rate? Bank of England. The Monetary Committee meet every single month and decide upon them, and they change. What are they trying to control when the interest rates are set? They're trying to control spending in the economy, saving in the economy, and regulate the economy, because a high interest rate will stop people borrowing, will make people save. A very, very low interest rate, which it is now, is trying to encourage people to spend within the economy. So we're going to be lavish and luxurious, buy them houses, get them holidays, spend on that credit card, because interest rates and borrowing is relatively cheap. Why do low interest rates affect the economy? Like I said before, because it sort of boosts the economy, because people can afford to buy that. So it sort of speeds up a lot of the process. If interest rates are very, very high, then people want to keep the money in the bank because it's worth staying in the bank. It's not worth spending. And to buy things on a credit card or use a loan would be far, far too expensive. It sort of puts people off. So I want you to think about now, what makes and what markets or products suffer the most when interest rates increase. So what markets and products suffer the most when interest rates increase? Pause the video. Pause. And I'll go through the answers. So markets that suffer when interest rates are the highest are cars, property developers, kitchens, furniture, holidays, everything luxurious. These are the type of things that nobody buys, or very little people can buy in cash. No one buys a car outright. A housing developer just doesn't have, $250,000 in the pocket. New kitchens, new furniture and holidays. The majority of these are spent buy now, pay later. Pay a deposit, pay for it later. Put it on the credit card. Get a personal loan to buy these things. So these things are bought on credit. These things see more sales when interest rates are low. Not a lot of people buy a holiday if credit cards and loans are very, very expensive. So necessities, however, so if your mortgage payments went up, people just absorb that. There's nothing we can do about it. So the essential things that we buy every single day with cash, even if they go up in price, doesn't really matter. But we do tend to see more savers saving when interest rates are high and less spending. Businesses are affected by interest rates in two ways. Loan repayments. If they've got loan repayments and that loan is very, very expensive, then what they've got essentially is higher costs. Higher costs mean that their profit margins are lower. So what they need to do is decide to whether, right, that loan costs me an awful lot of money. What do? I know I'll put the prices of my goods and services up to combat that cost. Customer spending, that's also affected by interest rates. Less people will spend if interest rates are high. So if interest rates are high for a business, A, their costs are going up because interest rates are high, and B, people are buying less because they can't afford to because they're scared to borrow to buy your product. So you've got to think of it in two ways. From a business's point of view, their costs going up, and then how the customer is affected too. Before we end the video, I just want you to be able to describe the impact of each. This will get you a grade C and above. Think about how each one links and tell the story. In order to get 12 marks, what we're expecting is to see lots and lots of connected because, therefore, this leads to, which is my BLT method, along with lots of other connective words to make sure we understand the pros and the cons, always coming to a conclusion. So can you describe the impact of each of these? Low interest rates. What does that mean? Well, it means that the cost of borrowing is less, so it sort of encourages people to spend more because interest rates are low, especially on luxury products like holidays, cars and houses. More spending. The impact on more spending is that businesses would see a higher profit, footfall would increase, sales revenue would increase, numbers would increase, and eventually, because of the higher profits, they should see business growth. What does business growth mean? Well, business growth means diversifying the product range, advertising, maybe going overseas, and more importantly, providing more jobs for people. And more jobs means that people will have more money to spend. Spending, which means that suppliers will eventually be able to reduce prices. There'll be increased competition in the marketplace, and you would like to think that a business will benefit from economies of scale. Buying in bulk, so it's cheaper per unit, and then costs can be passed on to customers so we can reduce prices. Then think of what happens then. Following that story. How about these ones though? If there are high interest rates, what might happen? People might keep their money in the bank, spend less, only on necessities, not luxuries, so therefore they might not move house, go on holidays, buy expensive cars, TVs and other white goods. If there is less spending, then I think businesses might see a little bit of a decline, especially those in an industry that might sell luxury products. People might be putting more in the bank. However, everything that they do get might be going into the bank because they'll see that as more an investment. It's better in there than out there being spent on a good. But suppliers might have to increase prices. At the end of the day, their bank loans, their business loans have gone up, and therefore they've got increased costs. So they might have to put them increased costs back upon us. So they might increase the prices. But we can't afford them. So how are the business going to reduce costs? Well, they might have to let people go. In this kind of time when everything is increasing in price, called inflation, then a business might struggle to stay afloat, and therefore there might be job losses to ease that pressure and cut them costs. Job losses mean that people haven't got no money, and if people haven't got no money, they're the customers, so there'll be less money in the economy. People are really going to tighten their belts, and they're definitely not going to spend now because jobs are unstable and their security's gone. Eventually, high interest rates over a long period of time affecting spending, affecting cost prices, and then resulting in job losses does mean business closure. Lots of businesses fail, especially if they can't make repayments on loans because they're high. Then what would happen? So think about always what would happen next, what would happen next. And if you were in charge, what would you do with the interest rates? Good luck.